Hi, everyone, and welcome to the In the Money podcast. My name is Joe DeFellon. I'm one of the directors of VFX Risk Management, and I'll be your host today. So, the red box is back, and so are the big promises. You thought Halloween was over, it's only just begun. Rachel Reeves is betting billions that Britain can spend their way to strength. But with the pound crumbling and companies packing up and debts brushing about 100% of GDP, is this economic revival or fiscal roulette? In this episode, we're digging into the markets, what they really think, and what all this means for businesses when they try to plan for budgets, hedging, and everything in between. Joining me today are two fellow directors of VFX Risk Management. To my right, Ben Policino, and to my left, Philip Stevens. Let's take a bit of a dive into the context of the upcoming budget and the political landscape. And over to you, Ben.
Perfect. Thanks, Joe. Yeah, so let's before we run through what we think could come from this budget, highly anticipated, of course, I'm just going to set the scene politically and provide some context. So firstly, let's go back to over 12 months now when the Labour government was elected. They made a few manifesto pledges. One of the main ones, though, is that they wouldn't raise taxes on working people. Coming into power, they said that they looked into the books and that they had discovered that an impromptu budget was needed to steady the ship and put some foundations in place. That budget took place and employers' national insurance was raised. That allowed the government to state that they weren't actually raising working people's taxes. Not too sure that they really got away with it, but anyway, that was the line that they took. Now, since then, what's happened? What's led us to this point? They have not been able to cut spending as they otherwise would have wanted. I think everyone will remember the MP rebellion when they tried to put in place a welfare spending bill, well, a cut to welfare spending. Inflation has remained stubbornly high. Last reading came out at 3.8%, almost double the Bank of England's 2% target. Gilt yields have been on a steady rise over the last 12 to 15 months, reaching a highest level in 27 years. And finally, which is most unfortunate for the UK, but also for the Chancellor, is the OBR is projected to lower the productivity forecast for the UK economy. This has a massive hand to play in the budget hole that they'll need to fill. All of that goes to say that Rachel Reeves isn't someone that I envy at the moment. She's got a very fine balance and act to run in this budget. She doesn't have the support from her MPs to lower spending. And as our FDs and CFOs will know, watching this, that if you're not willing to cut your spending, then you have to increase your income. And from a government perspective, their income is tax rises. It does feel that all of the levers have already been pulled, almost to the maximum level that they could do in previous budgets. And therefore, the only way that we're going to be able to fill this budget black hole is by increasing income tax, national insurance, or VAT, all three of which will break Labour's manifesto pledge not to raise taxes on working people.
And the whole is about 20-30 billion?
Yeah, it's looking like that. Very difficult to get an exact number because we don't have access to the data that the government does. But if you look in the market, be that independent economists, bank forecasts, then we're certainly looking at a 20 to 30 billion hole. Quite significant given that at the impromptu budget, we were filling a similar sized one.
You talk about no levers to pull, and I think I get it. If you're deciding that you're not going to cut spending, then yes, maybe you feel like there's no levers to pull. But they're the levers, right? We need to think about spending, and then that could potentially alleviate some of the tax rises they're looking to make. Benefits, net zero, depending on what angle you want to go. But I think they're the levers that other market experts or economists or particularly business owners, they're the levers that they're hoping she would pull.
Yeah, Joe. Well, I think in my mind, there's, I suppose, three levers that government can pull. Firstly, you've got spending. So you can either look to cut spending, reduce the government's expenditure, or you can look to raise taxes. Raising taxes, of course, you've got the headline ones, the ones on working people, income tax, VAT, national insurance. Or what you can look to do, which the Labour government has stated many times, is they want to grow the economy.
Yeah, I think for me, a lot of people that I'd imagine be watching would be thinking, okay, that's great. I appreciate the context. I appreciate the levers. What we do know is that we'll find out on the 26th of November exactly which levers are going to be pulled it seems very, very likely that tax rises will be one of those levers. But what does that mean FX markets are going to do moving up to that day? What does it mean they're going to do on that day? And what does it mean they're going to do after? I think a lot of businesses are thinking about budget rates for next year. They're thinking about what's the best way to prepare for what moves you might have on the 26th. I think there's been a lot of volatility in the last few weeks. You know, if you think specifically in sterling US dollar being in the 34s, the 35s, almost testing the 30s when Rachel Reeves spoke at sort of like an emergency speech that she put together. I mean, that in itself for me tells the emotion behind the 26th, because she wasn't going to say anything of like huge context on that day, but she wanted to, exactly right, right. And it was a concern that she didn't want, you know, financial markets to overreact. So she was trying to give them that warning signal. You know, look at sterling euro all the way down in the 13s as an example, having been as high as the 20s in this year. I mean, for businesses, that's a huge, huge issue, right? We talk about bottom lines a lot, right? And what margins some businesses have. And the move from 121 to 137 from January to July in sterling US dollar alone is enough for some businesses to not be making money on products, right? So I guess everyone's question is what's going to happen. And I think it's how do you best prepare for that day with either what you've got in place already or what you're looking to place and what products you're going to use when you make those decisions, really.
If we look at sterling at the moment, there is a lot of negativity. You know, and I think Rachel Reeves, on purpose would be the wrong word, but I think she is very much at the moment. We saw her do a press conference last week. She was doing an interview, I think, with the BBC on Monday of this week, and very much place or letting the markets know that she's highly likely to raise taxes and the economic situation with the UK. Now, why do I state that? Well, if we were to look forward to that budget, and it just so happens that it doesn't happen to be as harsh as what the market is forecasting. If she's able to make small tweaks to the three main taxes that I mentioned, but it's not as drastic as we thought. And actually, you know, the market reaction says, okay, I've got confidence in this Chancellor. I've got confidence in the Chancellor. She's going to deliver the reforms necessary, but they're also investing, as you mentioned earlier, around that other lever on investment. How can they get growth here? How are they going to grow the economy rather than relying on cutting spending or just raising taxes? And if she delivers a budget which isn't as harsh as markets think, puts confidence back in to the bond market, to the gilt market, and wider investor confidence, then I certainly think we could see sterling rally a little bit off the back of that in the near term.
But that's really interesting that you say that, because I remember on the desk just a couple of days ago with you kind of giving that rhetoric, right, and saying that's her only play. If you're Rachel Reeves, it's like, can I make everyone think it's going to be so much worse than it is? So when I deliver bad news, it's not taken in a bad way because we were expecting worse. And I said that to you and we were talking, and I said, okay, there could be a bounce. And then you said the quite perfect question. It's like, okay, but would you bet your house on a bounce? And I was like, well, no, I wouldn't at all, right? Because it still is going to be negative. And it's quite interesting, again, that when I started to believe in, I guess, how she's trying to approach the problem, I still can't buy into it because I still feel like the rhetoric is negative. And then there's that paradigm of we still just don't know. Like you said, you still don't know which way the coin will fall.
What you just said there is spot on. Going back to your point, is even if it isn't as bad as businesses think, do you think investors are going to buy into it? Because it's not just about this budget; it's about the long-term future. It's the long-term policy. It's, do investors think actually the UK could be another powerhouse, could be sustainable growth, achieve sustainable growth? Because if they don't, then the pound will weaken anyway.
Yep.
So she's almost rocking a hard place, because I think a lot of businesses, you know, we were speaking about it earlier, Shell, AstraZeneca, Pfizer, they're all withdrawing investment from the UK, moving headquarters back overseas. That creates less productivity, less money in our system, and less jobs.
Now, I think it's very difficult to know where rates are going to be on a long-term basis. And that's ultimately why some of our clients look at hedging products, right? They're not trying to forecast where sterling USD is going to be. So if we come down to, well, how much is priced into that negativity in sterling at the moment? And if the budget comes out or if she gives confidence, do we see a short-term sterling rally? Maybe, maybe not. Who knows? But equally, I then think you start to look medium term, and that's when the points that you two have raised will come into play. Okay, well, actually, it wasn't as bad as we think. There is some investment going into the economy. They're doing X, Y, or Z. But actually, let's step back a little bit. Look at the wider macro picture here of the UK economy, as you just raised. Unemployment's come out this morning. It's at its highest level at 5% since 2021. That's definitely a bad indicator. Inflation still remains stubbornly high. So I think if we were going to look at the I suppose, the more ingrained economic elements, then yeah, I think the UK, it would be very hard to argue over a medium and even long-term perspective, in my opinion, that the UK economy is on a good footing.
It's not just about the UK.
No, you're exactly right.
Trump wants a weaker dollar. Eurozone has got its own issues. Just because the budget might be bad doesn't necessarily mean we see cable drop or sterling euro drop.
The first question I have is, well, against which currency? Because what's going to happen to sterling, unless you're looking at it on a basket basis? If you're looking at it, as a lot of our clients will be, they'll be looking at, okay, well, I trade sterling USD. So what's going to happen in that currency pair? Now, some may trade multiple, of course, but just to make it easy for conversation perspective, what's going to happen in sterling euro? Well, they're two very different equations that you're trying to solve for there. So yeah, I think it's a good point. Again, if you're looking forward, you have to look at the underlying currency pairs. Because if I look at sterling euro, well, then there's factors, economic and political, going on in Europe that you need to compare to the UK and try and work out, well, where is sterling's value against the euro? And then you look across to the US, and that's the same thing as well. You've got different factors at play, and that will drive where sterling USD lands.
Well, it's interesting because you can do that already, right? You use euro dollar as your proxy in the G3. That's the most traded pair. And all you've seen is the euro weaken in the last few months against the dollar, and it moved lower and lower and lower. But yet you see sterling euro going lower, which tells you, at least from the offset, that investors are seeing sterling as the weaker of those two, which is interesting when we talk about, Ben alluded correctly about how the UK budget would look against budgets in France and Italy, right? And it's stronger, and we wouldn't talk about that. And in reality, we're still being seen as the weaker choice of the three in that scenario. Political instability in France, as another example, is something that probably, in my opinion, didn't impact the market as much as I thought it might have. I thought that was a moment where we might have seen sterling euro higher, kind of fallen. But what I find also interesting is we look at the Bloomberg forecasts a lot, right? Where we get 82 different forecasters on that table, updated every 2 weeks, etc. And when I'm looking at sterling euro and I'm looking at sterling US dollar, all of the more recently added ones are all showing sterling strengthening, which has made me feel like, okay, well, are we at the bottom? Is there anything else Rachel Reeves can say that we don't already kind of know?
Is it priced in, basically?
Exactly. Yeah. And a lot of the time, or how much of the time, is the move before the event? Because investors take their positions based on what they think is going to happen, and therefore on the day, it's not as dramatic unless something a complete curveball's thrown in.
So how do you, as a importer or an exporter, decide how to budget for that? Because you can never predict that sort of range. So you're either going to be massively in the money or massively out of the money,
depending on which side
you are.
Yeah, well, it's a great question, and it's one that we've basically debated for like 15 years, I guess, across all of our careers, watching and helping clients try to manage that. And the reality is there is no perfect solution, as we know, but what you're trying to do is reduce the impact of the move. And the way that you do that, either side, the way that you do that is by having a portfolio approach, which has multiple products in it, such that you have some level of cover at where the levels are at that given time. You're leaving some headroom to be able to add more, depending on where it moves, so you get an average rate. And probably what's ideal on top of that is to have a product that isn't just like a normal forward, that has an element of a range in it. So you're hoping that, obviously in that bit, you end up buying a lot more at spot, but you still have protection. I think making that makeup is what the real question for each individual client is, not even just direction, but it has to suit their business. Like we always talk about, Joe, right? It's what is their elasticity of pricing on their side? Do they have the ability to take percentages away from where the forward is to potentially gain upside? Or do they revise budget rates quarterly? Is it order book based, which is a lot easier, right? Because they can just put a rate against every single order and match it. So the problem is client base. It's not out the box. It really is bespoke. because you have to have those details from the customer to try to make that portfolio approach that matches them.
Yeah, yeah, I agree.
So going into it, right? Okay, I guess if you want to delve into it in more detail, look at if you're buying dollars, sterling US dollar, you want it to be as high as possible. Any kind of hedging you've done, you'd have been averaging up and probably regretting that you hedged, unfortunately.
Yeah.
But then I think now, obviously, it's massively come off from 37 in July, from 34s not too recently, testing to try to go below 30. I think you've got to reset your expectation in your mind and go, okay, like we always say, this is now a good place in consideration of where we've been. Is it the area to reset and say, okay, we're going to now look at 130 as our baseline and then move forwards?
If you are on the left and you're buying dollars and you budget yourself at 130 and then someone else holds off or maybe took some hedging out when we're at 135 for 18 months, then they're all of a sudden 5 cents better off than your commercial teams being able to sell at.
Yeah, and I'm sure commercial teams are very happy with
exactly.
that.
So yeah, but I think what we always talk about is having that level of flexibility, portfolio approach. There's ways to do it. I think gone are the days where people just stick a forward in, shut their eyes and just take it for what it is.
Correct.
Obviously the banks do that a lot, but it's more about fixing something, layer of insurance as we talk about, and then where we can, participation or just some flexibility with that, so you can roll with the volatility if it becomes more attractive.
Yeah, what does success look like, I suppose, and that's really unpicking that with that client, because if we don't know what success looks like, well, then it's difficult to build a solution for you, because how are you going to judge this? Because if you're literally just going to say, I'm going to book a forward, and in 12 months, if it's out the money, it hasn't worked. It's like, well,
yeah, exactly.
It's like, well, geez,
Peace of mind.
That's really difficult. There's some very highly paid men and women whose job it is to guess or forecast where the market's going to go and bet in hedge funds and banks, and they get it right probably not more than 50%. So let's not put that pressure on ourselves.
Right. Obviously, I was being a bit facetious with my Halloween comment in the introduction, but Ben, why don't you give us an actual overview of what we can expect to come from the budget?
Yeah, sure. So as mentioned previously, there's a hole of 20 to 30 billion sterling, which Rachel Reeves is understood going to need to find here. And 3 main tax revenues the government has is income tax, national insurance, and VAT. All 3 of which would impact Labour's manifesto pledge not to raise taxes on working people here. VAT, I would say, famous last words, is off the table. It's inflationary. You raise VAT, it's going to be inflationary. That's going to play into a headache of inflation remaining suddenly high, elevated, interest rates have to stay high, and then it filters down. So then we've got income tax and national insurance. Rather quite interestingly, there has been rumours or speculation that the Chancellor could look to increase income tax by, let's call it 2p as an example, but then cut national insurance by the equal measure. Now some people say, well, wait a minute, doesn't make any sense. You sort of up in one lower and the other, you're net flat. You're net flat, but it depends on whether, as is being termed, your income is from work or your income is from non-work streams or income streams. So what do I mean by that? Well, if you're we are working day in, day out, and you get a paycheck at the end of the month, or even self-employed, and you're doing it as and when you go, yes, you should be roughly net flat there. Certainly helps the counterbalance. But if you're looking at non-work income, so I'm thinking real estate, pensions, dividends. When I say real estate, I mean rent. Well, all of a sudden, your income tax is going to rise and you're not getting better than national insurance. So that may allow the government to then step back and say, we're not raising tax on working people, because actually we're only going to raise taxes on people who aren't working, who've got income coming from sources that is non-work-based income.
That's what they're calling the wealth tax.
Correct.
Inheritance tax, capital gains, real estate, as you say.
Correct.
So
yeah,
that's where the pinch comes, and hence why lack of investment. People want to put their investment elsewhere because they're not going to be penalised in the same way.
When you start to penalise what can be termed as wealth creators, so these are entrepreneurs, these are business owners, CEOs, board directors, CFOs, you start to penalise them, well, people take their capital elsewhere. They want to be in an environment. A lot of A lot of people, though, they don't mind paying some level of tax. They get the social contract that we have and they understand it, but it's just making it feel a bit fair. The levers there, a little bit few and far outside of that. There'll be other things that they do. I mentioned around freezing income bands. They'll probably look to do some other little bits, inheritance tax, etc. But those three things, one of them's going to have to move, and maybe they go down this route to try and, I suppose, not break their manifesto pledge. But what that does to growth, as you've mentioned, and productivity and investment into the UK, I think is in my opinion, quite a big risk from the Chancellor.
Okay, everyone, that brings part one to a close. Let's take a short break there and we'll see you soon. Hi again and welcome back to part two, where we continue the conversations around budget rates and the upcoming budget from Rachel Reeves. We'll also get an understanding and insight in where Phil and Ben think is best to set your budget rates on sterling euro, sterling dollar and euro dollar. Stay tuned. Okay, back to you, Ben, on this one. Is there a black swan-esque event or outcome that could happen that we haven't thought of, or you're concerned about, or our listeners should be concerned about as well?
If I was to look at, what could be considered as a black swan event from this budget, I'd probably look to the gilt market. So for those, I'm sure everybody does, but if you don't know what gilts are essentially the UK's government debt that they issue into the market. It's issued by the Debt Management Office, the DMO, on a regular basis. And the yields on gilts have been rising steadily. So I think I mentioned earlier that the highest level in 27 years. This is something which Rachel Reeves, Keir Starmer, and every Treasury official will be watching very, very closely. When I say that, what I mean is the rate of interest that they're having to pay to borrow money from the market. Now, like anything, risk reward. So the market will look at a certain issuer of debt, in this case the US government, and say, okay, well, this is what I demand back for my money. This is the level of risk that I'm placing on lending the UK government money. Yeah. That's what we mean by yields. Now, if we look at, as I mentioned, they're at 27, the highest level in 27 years. That means that they're higher than what they were during Trussonomics, during that mini budget fiasco. It's just happened over a slower pace. We've now crept a budget. For context as well, people say, okay, well, the yield's gone up. What does that actually mean? The cost of servicing that debt, so the interest that we as a nation, every single person listen to this, assuming you're a UK citizen paying UK taxes, we certainly are. What's the context behind that? The cost of servicing that debt is now 50% of the NHS budget. So it's forecast to be over 100 billion this year.
That's just paying the interest back.
That's just paying the interest. You're not touching the principal. So it's like an interest-only mortgage, okay? And it's almost double the defence budget for this year. So the defence budget for this year is, I think, around roughly 60 billion, and we're going to pay over 100 billion. And that's forecast to rise as well. So next year, I think it's looked to go up by around 10%. So it's a key. It's obviously, cannot overstate enough how important the gilt market is.
It's quite a competitive space as well, right? Because you have all of the other countries that are also releasing debt into the market. So you've got the comparison for the investor to decide what they think is about right from a value perspective. And that's also why I think what Joe was alluding to, the other factors that make the UK more attractive or not are playing into those yields, right?
Correct, yeah. It all makes a play. And I think that goes into, if we were to say what could be a black swan event, that sort of then plays into, okay, those investors, the market, as we'll term it, they lose confidence in Rachel Reeves. Not to single her out, the Labour government. They lose confidence and they're like, no, do you know what? For order for me to lend money to the UK, just to be clear, the DMO, I think, does it on a weekly basis. It's not like, we've got 6 months before we have to issue new debt. We constantly have to keep doing this. Actually, no, I need a higher rate of return here. That then spirals, that then puts further pressure on the UK government, and suddenly we're back to, not to sound too dramatic, an impromptu budget or a mini budget fiasco like we saw with Liz Truss and Rachel Reeves, the Bank of England stepping in to calm markets, an emergency budget. I don't think we'll get there, but we have a rerun of when the UK took out an IMF loan, I think back in the 1970s. because ultimately the market lost confidence in the UK. That's the black swan event, and that, I believe, is what Reeves, Starmer and Treasury officials will be watching very, very closely. I hope for myself, and I hope for everyone listening to this, that doesn't happen.
Yeah. We found a great chart this week, right? I mean, we were sitting at the desk and we were having a look, and there was a complete negative correlation between the popularity of the Labour government and the 10-year gilts yield, right? And it was literally like the more unpopular Labour got, the higher yields went, and almost in direct correlation, like an X. I don't know if we're going to show it so that people can see it on the screen or after or whichever, but everything you just articulated almost hit you in the face when you saw the graph, where you're like, there's the investor emotive factor here, where the more unpopular they get, it's just going to continue to price higher and higher and higher.
Looking at it, it's a little bit unfair on Labour, right? Because I think you could almost have any government there, but what it does tell you and lead into that, that I suppose that emotive side, which you say take the emotion out, but also that side of the market, just looking at it, saying, okay, well, you've got a government here, popularity, and then it does, and you've got yields down here, and what you see is that popularity decreases, the cost of borrowing goes up. Now, what can we take from that? Investors aren't looking at just how popular is the Labour government, of course, but what they are looking at is the underlying metrics to that. Well, actually, okay, why is the Labour government not popular at the moment? Okay, well, inflation's still high, growth is still low, the cost of living is going up. They're going to have to, they won't do tax cuts, etc. But it sort of plays into it, and it's certainly an interesting graph to look at.
I think that brings us quite nicely on. We'll play a little game, quick fire round. Ben, just give me a number. Cable left, so buying dollars, budget rate for next year.
128.
Phil?
130. Psychological.
I'm buying with Phil. Okay, same question. Ben, selling euros, buying pounds next year.
115.
I'm not gonna cheat. I would have said 116.
Okay.
Yeah.
Selling euros at Ben. Euro dollar left.
112.
112 buying dollars, selling euros. That was.
Not cheating. I was going to say 12.50. I wasn't trying to be awkward, but I feel like come down to 15. Sharp decline. Definitely need a buffer. Not expensive premium paid to paying at hedging. I was like, I was thinking 112ish and just maybe a little bit more, because I think someone in a boardroom would question, well, that's quite far away from where we've been. Yeah. So I was trying to give myself a little bit more of a buffer.
Yeah. Okay. Buying dollars, selling euros at Phil.
Yeah.
I'll go Phil first. You see, it really is cheating. Selling dollars, buying euros.
Selling dollars, yeah, got it. Definitely under 120, without a shadow of a doubt. The question is how close to roughly where we are now. Premium on the hedge, I would say 18.
118.
Yeah.
Well, no, I'd be at close to 120 at a push. 119.50.
Yeah.
Dollar weakness. There's too much risk in the market to not be to go lower than that.
Yeah, it's ugly though, isn't it? 119.50. That is.
Doesn't feel right.
Even 118 doesn't feel great. Right, thank you everyone. Thank you for listening. That brings us to a close. We've heard today that whilst investment and ambition are back on the table, credibility and delivery will be the currency that really matters. We'll be back soon to break down how the markets actually react to this one once the red box is open. Till then, stay hedged and most importantly, stay in the money.